Welcome back to another week of the Educated Home Buyer Live with Josh and myself here to update you on the economy, update you on rates and housing, and more importantly, to answer your mortgage and real estate questions to help you become the educated home buyer. So week over week, not a lot of changes for the most part. Rates, as we'll talk about a lot tonight, I'm sure, are a little bit higher than they were last week. Not a bunch, but they're definitely still up. But we did get pending home sales coming in a little bit stronger than expected, over 7% year over year, or month over month, rather, 7% increase in September, rather, up 2.6% year over year. And GDP a little bit stronger than expected. We're going to talk about some of the stuff. Core came in a little bit higher. So there were some things that came in today negative, some things that came in today positive. And overall, they kind of offset each other when it came to the market, the 10-year, and ultimately mortgage rates. So with that, Josh, anything you want to cover, get out of the way before we give them what they're looking for.
What I would like to get out of the way is that I'm ready for the election to be over. 9,000 texts a day, every commercial on every show, especially sporting events, being one side or the other, or both generally in the same commercial break, saying how dumb the other side is and evil or whatever so I will be happy for all of the negativity of election season to be over and the swirl of uncertainty surrounding the markets. So hopefully this time next week, 8 days from now, one day after the election, we'll have all the clarity in the world, but it may take a couple weeks actually.
And you're not a Dodgers fan, you're not a Yankees fan, but tonight it could be over. Is tonight the night for the Dodgers, or does it go another night and come back to LA?
I say yes. I say it ends tonight, and I don't care for either team. I kind of dislike them both equally. Mainly their fans. So if you're a Dodger fan or a Yankee fan, it's mainly you. It's not your teams. But what
That's
I
how
will
I feel about the
say,
Red Sox, the
the
Buckeyes.
Red Sox fans are bad too. But anyways, that game last Friday night and Freeman hitting the grand slam, that was one of the best sporting event moments in the
Sure.
last couple of
And last night,
years.
another great. I mean, honestly, not a big baseball fan. Games are too long, season's too long. But I will say this is the best playoff series of baseball that I remember watching in a long time. Maybe it's because I don't watch a lot of them or remember a lot of them, but this one I remember. So anyhow, you guys aren't here for that. Let's do as we always do and start with some charts here, looking at inventory. And then we'll dive into some things happening in the economy. But less inventory. So inventory, we actually ticked down week over week. We're now sitting at 738,000 unsold single-family homes on the market. 31% more homes on the market than this time last year. We were up 40% just a couple of weeks ago, but because of that seasonal effect, inventory typically comes off the market this time of year. And so those numbers are starting to come down. Now, is this the peak, Josh? Hard to say at this point, as we've said week over week, but I think I've been saying this for a week or two now. We've got to be getting really, really close to the top because we're headed into November, headed into Thanksgiving, and the holiday season, Christmas and Hanukkah or whatever you celebrate, and typically a time of the year when homes come off the market.
I believe, Jeb, it's called Chrismica.
Chrismica, I like that. What? How do we add Kwanzaa in there?
We can have all of them. We can have all of them.
Well, you need to come up with a word that gives them all. Orange County, Huntington Beach, down nearly 2%, just over 2% in Orange County, now sitting at 3,546 homes. Huntington Beach up a little bit week over week, now sitting at 232. My guess is the seasonal high for both of these, or the yearly high, is probably in. I would imagine inventory to stay flat, probably go down from here on in Orange County and Huntington Beach. And if it does tick up, I don't think that it's going to go back up above the peaks that we've seen. But again, to be determined, and we'll know a little bit more over the next couple of weeks. New listings, 6% more sellers this week than last week. We had 60,000 new listings with fewer immediate sales, fewer properties going under contract. A lot has to do with rates, time of the year, people waiting on the election, so many things going on at the moment. Interesting note that Florida new listings actually rebounded while Texas and California both ticked down. So natural disasters have passed a little bit in Florida, hopefully seasonally. And so inventory starting to come back there. So we mentioned inventory going down, went from 739, 434 to 737, 997. That last week was the peak for the year. So we'll start looking at trends going forward. Last year we were sitting at 562,000. So inventory actually went up this time last year. This is about the time we were hitting that 8% interest rate, right, Josh? So people were flooding the market, trying to say, "Hey, getting out of this. I don't want to hold on to this property. I don't want this to be the, rates to continue rising and me not be able to get out of this." So we actually saw inventory rise this time last year, which is not normal. But for context, back in 2015, we were sitting 1.168 million homes on the market. So we're probably about 60 to 70% of that at the moment, 60% or so from where we were back in 2015. This is total home sale contracts pending, sitting at 356,127. That's a total contracts. And then if you look at new listings, 59,000 contracts pending. 9% more homes going into contract this week than last year at the same time. Probably has a little bit to do with where rates are this year versus last year. Mortgage payments are still climbing, though. Mortgage payments are still climbing, still 6% less than last year. So mortgage payments are a little bit less than they were last year, but at the moment, unfortunately, they're going up because of interest rates. Median price of new contracts sitting at $359,900. The expectation is that this will essentially start to ease here. And at the moment, there's just not enough demand out there in the market, again, because of all the things that we've talked about time and time again. And the last thing we like to look at, Josh, I know you want to say something about price cuts. Currently sitting at 39.5% and essentially been unchanged for the last 12 weeks now. So the number of properties sitting on the market, having price reductions isn't really changing.
It wasn't, Jeb, so much a comment about any one of these individual slides, but you had mentioned month over month was up, what, 7%? Is that what you said?
In which one?
You
pending home sales were up 7%. Yeah.
So if you look at that,
yeah.
that reflected not the absolute bottom, but close to the bottom of the rundown in rates, July, August, September. So late part of September, first part of October starts absorbing that. It just goes to what we've been saying. We don't have a demand problem. We have an able demand problem. People that are willing and able to pay the prices, and it is very, very rate sensitive, both in terms of sales volume, sales prices, all that fun stuff. So we got to look, Jeb, this week at home prices, both in terms of FHFA and Case-Shiller. Both of these we talk about. We don't love median home prices. Better measures in that they are repeat sales indexes. Case-Shiller, the reason why you see differences in these is the FHFA index doesn't include cash buyers, and it also doesn't include jumbo loans. So there's just some other things in there that may be trending lower. But if you look at this across the country, 5.7% from 22 to 23, but moderating from 23 to 24 for the FHFA number. And that's good. We look at this 4.2. We saw some of the headlines, some of the news articles were talking this week that when this came out, that the long-term trend is 4.8, so we're seeing a slowing market. You're going to see in the next slide or two here, 4.2 is still pretty strong, and then where you are regionally makes a pretty big difference. Some parts of the country here are up year over year, but still below that 4.2%. And other parts of the country, mainly New England, the middle Atlantic states, up almost 6%. East, North, Central, 6.3%. Those are healthy gains and not necessarily what we want to see after a period of really, really unhealthy gains. So I wanted to throw this in here. This is the Case-Shiller national and composite indexes. So 10 is 10 of the biggest cities. There's another one they stretch out to 20, and then national is their national index. So I kind of wanted to show everyone knows 2006, 2007, we got way above that long-term trend. So that green arrow is basically what that long-term trend, it's not a perfect fit to that data set, but it gives you an idea of what that long-term trend should look like. And if we drug it out, probably says this index should be somewhere around 260, 270. Instead, we're sitting up here around 310. But the biggest thing, that red arrow, was COVID. When we had rates go down, people prioritized housing. Affordability was really high, even though prices were high. We saw a giant spike, little tiny dip, and then this sort of yellow trend line here. it's above what we want to see and likely what we will see over the long haul. So here's another look at it. This is the year over year change. So I put the green and the yellow band on there. That green band shows us what a normal
Fancy.
healthy market is 1, 3, 5, 6%. Once you get above that, so we had a couple of time frames here where we were way above that. So 2001, almost all the way through 2007, we're seeing double-digit growth every year. Then we had this brief period with a giant spike during COVID, and we're kind of back in the normal range, but likely, Jeb, you and I have talked about this. The long-term trend is for affordability to just lessen over time. Homes get more and more expensive over time. But despite that, I think it would be reasonable that we would expect a period of lower growth. I don't know that 4.8 is reasonable to think that we'll have that over the next 10, 15, 20 years when we just had a bunch of that growth pull forward. So it'll be interesting watching this data as we go. The last one here, I thought this was helpful. When we look, we talk about on the show here, what is a normal market? What's the demarcation between a buyer and a seller market? A lot of times that's posited that is 6 months of inventory and it becomes a seller's market. Well, when you look here, the left side, the dots on the low left, when we get inventory over 6 months, that's where we start seeing these dips in home prices in month over month. So you see, we're still seeing almost 0.5% a month growth, 0.4% a month growth, because we're at about that 4 months of inventory. So going back to that story of affordability, if rates drop, Fannie Mae came out with their projections this week. I'm not sure if you saw them, Jeb, for 2025. And it's an interesting way of saying we expect to end the year at 5.9. So a year from now, they expect rates to be 1% lower than they are today. If we get rates 1% lower, that does enough to affordability that it's not going to, the question we get here all the time is, hey, if rates go to 5.5, if rates go to 5%, does that mean that we have 1 million buyers and there's no inventory and you have bidding wars again? You tell me what your thoughts are, Jeb. But to me, it says we probably stay somewhere where those black triangles are, somewhere between 3 and 5 months, but it keeps us from going over the 6 months. So it'll be interesting to watch this data as it plays out over time.
Yeah, I mean, I don't disagree with that. I think, I would hope that rates are lower than 5.9% by a year from now, just with a slowing economy, with the idea that we're going to see a slowing economy and that things are going to normalize a little bit. Hard to say at the moment, right? Again, we'll talk about some of the stuff in the episode, I'm sure, because questions will come up. But the idea that if Trump gets elected, the market's kind of pricing in the fact that Trump's going to get elected. That's what the market is expecting with the way that bonds are moving, because they see him as inflationary, and being inflationary and causing, with tariffs and all of the tax, deductions, all the stuff out there that essentially the market doesn't want to see. Well, I guess depending on who you are, you don't want to see, and therefore the bond market doesn't like it. And if that's the case, if he doesn't come in, does the bond market, I guess, Josh, does the bond market automatically pull back, right? If he doesn't come in as president, for example, he doesn't win the seat, does the bond market come back the other way in a quick fashion because that's no longer in play? Or does it take some while for that to normalize? We can talk about it after we look at the slides, but I think it's an interesting point.
The thing there is a recipe there, Jeb, for a rather quick correction in interest rates, not meaning going back to where they were a month ago, but a rather sharp and quick correction. And we'll go through them in my slides here in a minute, because we're going to talk about, we get a chunk of data over the next week. The big data point is the one you're talking about, the election results. If you look at it, the presidential results, they're always a wild card. So, okay, cool. Today, 6 days before the election, everyone's convinced that Trump is going to win. We'll see how that plays out. But I was looking at the House and the Senate. We've talked about the sort of that run up, the Trump premium going into bonds right now is not just about Trump winning. It's about him getting the House and the Senate behind him, where he can do whatever he wants to do. I looked at it and it looks like, I'm not paying enough attention. It looks like the Senate is pretty much done. That is going to stay with Republicans. The House there's more swing seats, there's more open seats that could go either way. So if we get here next week, regardless of who wins the presidency, as long as we split the other two and we have a bunch of other data, if we get some soft data, primarily that jobs report on Friday, you could see a fairly big correction in a relatively short period of time. Now, the opposite could be true also. You get this red wave that the market is fearing. We get a hot jobs report on Friday. Rates could trend higher over the next week.
Yep.
So volatility is high. The risk is high either way. Through this one in here, Jeb, we also got Fannie Mae data for delinquencies, and the headlines always make me laugh on this one.
I saw it.
Delinquencies rose, and I believe it went from 0.52 to 0.54. The only reason why I threw the green line in there is to show you that pre-COVID, we had historically low levels of foreclosure, and we are below that. So 90 days plus or in foreclosure, that's serious delinquencies. That's not, I had a problem, I missed my payment. So just to give you an idea, anyone who's expecting a big wave of bank-owned properties and a big downturn in prices, you're going to see it first in this data, and it is trending up, but more accurate to say it's trending sideways as it has for the better part of the last couple of years. Boy, oh boy, Jeb.
What happened to your formatting?
For those of you watching at home, we had issues with importing into StreamYard that we stream with our Google Slides, and it butchered. We had to do it in PowerPoint, and it butchered our info here.
Yes,
so here's the data that we had teased last week. Yesterday we got JOLTS, came in at 7.443, so 7.5 million job openings. It was forecast at almost 8 million, and last month was just a little over 8 million. So this was really good for the bond market, and we had a little bit of improvement yesterday, about 20 basis points improvement. Today we had mixed data. The ADP employment report came out, 233,000 jobs created last month per ADP. That's 115,000 were forecast, 143 previous. So any way you cut it, that's a fairly big beat. I mean, 233 is not an astronomical number, but it is very big relative to expectations. GDP there, we got the first reading for Q3. I believe this gets updated 2 more times. They were expecting 3%. Previous was 3%. Came in at 2.8. Came in a little bit light of expectations, but not enough really to move the markets. That ADP, we pretty much gave back all of the gains yesterday. So in 2 days, we've got a lot of data, and it's pretty much offset. One was good for interest rates. The other was bad for interest rates. Look at this, Jeb. Our data is just
take this thing down and talk about it. This is awful.
So tomorrow we get a look at PCE, the Fed's preferred measure of inflation, and then we get the weekly jobless claims tomorrow, continuing claims and weekly claims. The problem, Jeb, is I don't know what's on there. Hold on. Let me get my slide back over. I got my slide. This is actually a good idea because I can see it. Friday, we get the actual jobs report, and then Tuesday, election day, we also get S&P Services PMI and the ISM non-manufacturing PMI. Then next Thursday, we get the Fed announcement. So that's a lot of data coming in a short period of time. The big ones being PCE tomorrow, which should trend better. There was a little bit of a concern that GDP number that comes out today. There's some data that leaks into PCE, could indicate maybe slightly hotter than the market is expecting. But we'll see. We'll see that PCE data tomorrow, and then we get the jobs report on Friday. So for all of us not wanting rates any higher than 7%, we definitely hope those go a certain direction. We've talked about the election and what we would, from an interest rate perspective, what all of us should be hoping for. And then in terms of the Fed next week, Jeb, we're looking at they are likely going to just go right ahead with the 0.25%. There's no reason to not do what they've planned on doing. So in terms of this, I don't know if you've seen this here recently, Jeb, but that CME Fed Watch. So 95% chance they're going to cut a 0.25% next week, 70% chance they'll cut at the last meeting of the year. But you'll notice the rest of it, we got 50-50 for the next 2 meetings for a cut, a third of a chance at the next 2 meetings. So that's way, way down. If you remember, this was basically saying 0.25 point to infinity as recently as a month ago. So this is volatile. It is real. It's the futures market. It's real investors putting real money on the line, but it changes. It changes fairly rapidly, as you can see from what this looked like 6 or 8 weeks ago. Nothing good to see here in terms of this chart, Jeb. We are riding that up channel all the way up. We're currently right at about just under 435. We have some support at 435. If 435 gives way, then 450 is the next critical level, and that's going to come based off of the data and the election over the next week. Wanted to throw this in here. We had talked about, up until this week, the spreads between treasuries and mortgage-backed securities had held, or mortgage rates had held fairly nicely. We gave back 10 basis points of that this week. So as rates go up, lenders don't like putting these higher rate loans on the books. So they're requiring a bigger premium above and beyond Treasury. So Treasuries performed poorly in the last week, mortgages even worse in the way lenders are pricing them. So what does that look like? You hinted at this, Jeb, through a little over 7.02, a little over 7% on the 30-year. FHA and VA in the mid sixes. And last day, not much change, up about 1/8% over the last week. So hopefully we come back next week and we're talking about 6 3/4, and we've got some things moderating and some certainty in that. But that's what we're looking at.
And if you're one of those people that's in contract, you're searching for a loan, you're going through the pre-approval process, want to talk to a professional, Josh and myself, our team here, you can get in touch with us using the referral link that is scrolling the bottom of the screen there. And if you're any of those red states, we can definitely help you. And if you're any of the blue states, we can refer you out to another member of our team who can guide you through the process. So either way, you're in good hands. Just reach out. And then if you're on the real estate side, essentially, we can help you in any state there. In fact, I've helped 3 people in the last 3 days get in touch with a realtor, 2 for selling and 1 for buying. So if you're looking to sell, looking to buy anywhere in the United States, we can be a resource for you. So definitely reach out and let us help you. Let us use our expertise and guide you in the right direction. So with that, now is a good time to let us know where you're watching from. I know some people have put in there where they're watching from, but start putting your questions in. If you have questions about what's going on in the economy, what's going on with housing, any specific questions related to mortgage and housing, and we'll get to them. But more importantly, we'd like to know where you're watching from. So do that, and as you do that, we will start to look at some questions here, Josh. So, you haven't flagged anything yet. So here's a question. I haven't even read it. We're just gonna throw it up there. Says, why don't you use 2019 number instead of 2015 number for some context slide? Because that's what they put on there. Going back and getting some of these seasonal numbers from years past, if you don't have your own data set, is very difficult to do. Housing Wire puts out that slide that I put up. And the context that you're using is 2015. So that's what we're using. 2019, it's still up nationally. So we're still below those numbers. How much? Hard to say. I don't know specifically. I'll try to see if we can get that information. It's just very difficult to aggregate some of this data. Especially going back that far and trying to get the right information, because unfortunately, some like Realtor.com uses properties that are active and pending under contract as their active inventory, whereas other sources only use what's active, not using pending or under contract stuff. So you can get very, you can get pushed in the wrong direction really easily when you don't actually know what you're talking about. And unfortunately, they don't provide a lot of information on some of this data that's being pulled. So we try to provide you with the stuff that is valid and relates to now. So,
and Jeb, if you look back at that timeline, 2015 was really kind of the tail end of that bust. So 2008, 2009, 2010, 2011 were all bad years. 12, 13, 14, 15 were kind of coming out of it. And what most of us think of as a post GFC normal was that 2015, 2016, 2017, 2018, 2019 range. And they were all pretty consistent, pretty similar. So that's sort of the reason why people look at 2019. It's where the market was at prior to COVID and all of the COVID distortions with cheap money there. And you can look at it a couple of different ways. Many people were expecting some type of correction, both in terms of a recession prior to COVID and a real estate correction. We don't know. We don't ever get to play that version of history. It's not ever going to play out. But 2019 is anyone's best guess at what the last normal market looked like.
All right. So we have Maria. Oh, we don't have Maria. I don't know if it's Maria or not. We have M. Cano. Says, hey guys, thanks so much for grinding these videos every week. I finally got my home and used a lot of your advice. So thank you for that. Also go on to say, now that I have my new home, there's so many things to worry about. Can you go over the top 3 things that new homeowners in California need to keep in mind or be ready to address? So I don't have a list off the top of my head, but I'm going to rattle out a couple of things that I think need to pay attention to. Whenever you get a new home, you're going to get mail, and it's going to make it look like official documents that you should pay for some sort of whatever they're offering. The reality is it's all garbage. Don't pay for any of that crap that you receive in the mail, even though it might look official and want you to pay 25 or $50 to do something. Not necessary. Don't do it. It's an easy way to capture money from people that don't know what they're doing. Secondly, is what I would say is put your property in a trust. If you have heirs at all, family, anybody that might, that you want to leave your property to, your stuff to, at least get a will, get something that says where your property is going to, so that it's not in probate, so that it's not just stuck out there. Nobody wants, that's the last thing people want to deal with, in an emotional time and all of that. Josh, what's a third thing you could add in there? It's important.
The question is specifically about California. We're fortunate in California because of Prop 13. You don't really have to worry about a reassessment. It can only go up 2%. To 2% increase to your property taxes, while not welcome, isn't catastrophic. Other parts of the country where home values are catching up, some of these states only do their reassessments every 2 years. It would be something to be aware of. So hopefully during underwriting, your lender, your underwriter went through and kind of explained to you what you can expect going forward. But yeah, getting it into a trust. If you have, getting all of your insurance policies in line. A lot of times when people are going through the process, they just jump in and go, "Oh, I got a quote," or "Hey, this is who my auto insurer is, so I got a quote from them." Now that you have a little less pressure and you have a little bit more need for insurance, maybe check around and shop it all and see if there's an opportunity to save. And that comes from my situation. I literally got my renewal. It's included in my monthly mortgage, so I didn't really pay attention to it. I pulled it open last week and we went up $500 over the last year, and that's not typical in my area. Going up,
It's like
yes,
30-some%, right?
yeah, it's a big jump. So should be able to make some calls, and I may have to change providers, but I would expect that I can get it back to where it was last year by doing a little bit of legwork.
Yeah, you should do that every year. Insurance, guys, car insurance, house insurance. You should look at the premium, compare it to last year, and then go do a little bit of shopping. With that, we've got a couple people. We've got North Carolina in the house, Albemarle. We got Albuquerque, New Mexico. Got Oregon. So we got we're coast to coast so far. Not a lot in the Midwest or in the middle states there. So the flyover states, if you will.
100%. While we're on this, Albemarle, North Carolina, Kevin we're just really close to wrapping up their refinance. They built a home a couple years ago, beautiful home, and ended up getting a much higher appraisal than what they thought. So that worked out really well. What I wanted to say at the top of the show, and we didn't go through it, for those of you who missed that window, a lot of people were expecting that rates were going to go lower, going to continue going lower forever, held off. If you missed that window and you have an idea of where you want rates to be, want to talk to someone about where rates need to be before it would make sense to do something, we do have the rate watch set up here. If you go to that link, theeducatedhomebuyer.com/P/rate watch, just get your contact info, allows you to upload your mortgage statement. And that gives us everything we need to plug you in. And, we've talked about the numbers on the show. If you have a $200,000 loan, you need a bigger savings than if you have an $800,000 loan.
Mm-hmm.
So with all the information on your mortgage statement, we just plug you in and the system pings me as soon as there's an opportunity for you to save. So if you want to take that off of your plate and have someone watching it for you, go ahead and use that link.
Good stuff. And Josh, why don't you take that link and copy and paste it into the chat there? There's 114 or so people on at the moment. It's easy to click it and go there. And I know some people are on Facebook and some other places too. So hopefully it'll carry across there. Just make sure you select the right thing at the bottom, Josh, so it doesn't send it to 5 people all in the same thing. So anyhow, Inglewood in the house, Kinston in the house. So Jason, thanks for letting us borrow your four-wheelers when we were back there. The boys had a blast. I know that was you. So thank you very much for that. That was awesome, man. You might never let us borrow them again based on getting them back, but the boys had a fun time. So let's see. Josh, there was a good question here that we got at the top of the show from Nicole. Says, how long is a soft credit pull valid for? So Josh, maybe talk about what a soft credit pull is, and then maybe we can answer the question.
I was going to say this is a trick question because a soft credit pull is not valid for anything. In certain instances, we can use it to run an automated underwriting, give us an indication, but it's always going to have to be upgraded to a hard credit pull. So a soft pull just means we're able to get the same data. We're able to see the payment history. We're able to see the debts that you have. We can do a 1, 2, or 3 bureau, just like a hard credit pull, but it's not going to put an inquiry on your credit report because it can't be used for issuing credit. So from that perspective, we have one of our lenders that we're able to do a soft pull on the front end. And then at the very end, about a week before closing, then they will upgrade that to a hard pull. And in that instance, I believe it's the same 120 days. It would expire after 120. But if the lender you're working with doesn't have the ability to upgrade that soft pull, they would have to do another soft pull or do that hard pull at the end, which there's always going to be a hard pull. So worrying about how long a soft pull is valid for, again, it's not valid at all from the very beginning, and it's going to have to become a hard pull at some point. So if you're getting to the end of the transaction and the soft pull is no longer good, you would just do the new hard pull.
Good stuff. So we're 30 minutes in. If you found any value or you're finding any value, answered your questions at all, do us a favor, hit that thumbs up. If you're not subscribed to the channel, consider doing that. And as we mentioned earlier, there's a link scroll in the bottom. If you're looking to refinance, maybe just get pre-approved. Want that rate watch that we talked about earlier, which Josh, I don't see that that link in there. So I don't know if you posted it yet.
Just threw it in there just now.
There you go. You can reach out and we can definitely guide you in the right direction. So there's a question here following up, Josh, just asking, are credit unions better than Fidelity when it comes to a mortgage? So I didn't know Fidelity did mortgages, but perhaps they do. We talked today on today's episode about shopping for a lender, what not to do when shopping for a lender. We talked about this specifically, but kind of give your 2 cents.
There is no, if anyone tells you always go to a broker is best, you can't make that blanket statement. If someone tells you always go to a credit union is the best, cannot make that blanket statement. So going back to what we talked about on the show today, that'll go live next Tuesday, Jeb, is what do you need to know? If you only talk to one person, you could have got the greatest deal in the world. You could have got the worst. So we need at least 2 to make a comparison. Probably 3, and we want to go to different channels. So if you think you might be well served by a credit union, talk to them. We don't know who Fidelity is. If Fidelity is a local mortgage company, talk to them. So now you have 2 points of comparison. Possibly talk to a third. The rate and terms are important, the knowledge and expertise, and then your communication, rapport, and service levels from the person that you're dealing with are equally important. So there, we just boiled a 30-minute episode down to 12 seconds, Jeb.
There you go. And with that, we actually talked yesterday about the election on the podcast. So if you're interested in hearing housing policies, how it might affect the market, I know a lot of people out there have their opinions. We kind of go through it overall. So it's on the podcast. It's on YouTube. Check out that episode if you haven't done so already. And next week, we're actually covering what not to do when it comes to shopping for a lender. Josh has had the opportunity to speak to a lot of people here in the last couple of years, but really in the last 30 days, 40 days, with the rates kind of dropping and all of a sudden people wanting to take advantage of it, that we've seen a lot of instances where people are making bad decisions, doing things the wrong way, and it's costing them money, time, even the rate in many instances. And some people now aren't in a position to do things because of how they did it. So make sure you stay tuned. It'll drop next Tuesday on the podcast and here on YouTube. So, Josh,
Jeb, before we go there, a story that I didn't get to use on the show today was someone that reached out, that we have them on the rate watch, that they actually had their loan in process, loan approved. And the lender told them, or the loan officer said they didn't have enough information to get it locked. And so the rates got away from them and didn't lock it. And they have a fairly high interest rate. So with that, absolutely should have been locked. I mean, you can't fault anyone for not knowing the absolute lowest day to lock, for being able to talk a borrower into locking that day. Many borrowers, folks just like you, were like, no, I don't want to lock. It's going to go lower. Nope, I know it's going lower. No, everything's going to get better. So the issue is when rates are now 0.75% higher, than who you work with is important. So one of the things we talked about on the episode, Jeb, is, okay, you're shopping for competitive terms. But if you call around and you found the lender that has the absolute best terms, but they screw around and you miss your lock window by 3, 4, 5 days, or sometimes by 1 day, it can cost you far more than the difference between the best price lender to the worst price lender. So maybe we have to go back and record a little coda to that episode. Part of it is ask the person that you're thinking of working with, how do you manage the lock? When do we decide? What information do you give me? Because I hear some of the craziest shit all of the time of loan officers saying, hey, rates are up, but next Tuesday is going to be leap year, and therefore we think it's going to come back down. Everyone has an opinion. I have opinions. Don't take opinions. What data is informing that opinion? And then you're going to need to make your own answer.
All right, good stuff. Let's see. This one, Siete, you just asked. You're asking how would this year election and FOMC meeting, the Fed meet affect interest rates? We talked about that yesterday in the podcast that I just mentioned a moment ago. Go back and listen to that, or listen to it rather if you haven't done so already. We talk about what the president does with controlling the Fed, what everybody's looking at in order to make those decisions, and how it might affect rates. So that'll give you a little bit more guidance on that, and where we think things are headed on that front. This one, Jacob, yeah, Jacob is saying, I'm in the process of buying a home. They're estimating my APR at 6.675%. So that means absolutely nothing, by the way, because if you have an FHA loan and interest rates are today at 5.75% and you got a 6.675 APR, that means there's a lot of fees being charged in there. Could be the upfront MI. It could be a lot of things. The APR is not important. It's not valid for so many reasons, and not enough to go into here, but understand what you need to pay attention to. And Josh, obviously you can confirm this and or tell me I'm crazy, but we've talked about it so many times. You need to pay attention to your rate, your interest rate, not your APR, your interest rate, which translates to your monthly payment. And then you need to pay attention to box A on the loan estimate, what you're being charged for that interest rate. And then you can look at box J too, to see if you're getting any credits to offset box A. But in all reality, APR means nothing. Yes,
it's
no,
it's a synthetic it's a synthetic number that the government made up to allow you to compare loans, but it's more confusing. I've yet to have a borrower tell me what APR means. They'll mention it, they'll reference it, they'll say, hey, you told me my rate is 6.5. Why is my APR 6.675? Well, because it's a synthetic number meant for comparison purposes.
Over a 30-year term.
Over a 30-year term, if you kept that, paid it out to maturity, certain fees are considered prepaid finance charges. They come off of your loan amount. That's what pushes the rate higher. Not everyone calculates it the same. Not everyone calculates it accurately according to the letter of the law. But even if they did, it's not a super useful tool. What is this loan costing me? What is my monthly payment? And the actual note rate, your interest rate, is what it is. So when I was thinking partially the same thing as you, Jeb, when I saw this comment, I was in the process of buying a home and they're estimating my APR. I don't ever estimate your APR. We use a number for your pre-approval because we have to, right? We can say, hey, well, as of today, this is what today's rate is. We probably want to put a little pad on it in case they get worse, but you want to have an idea of what your payment is, but it's not an estimate. There's never an estimate of a number. Here is the rate that we could lock today. Here is the number that we are using for your pre-qualification, for your pre-approval. So if you're in the process of buying a home, if you have a home under contract and you're not locked right now, I would be shocked. I have 3 different advisory services that I follow, and every one of them for the better part of 3 weeks is like, lock your rate, lock your rate, lock your rate. So hopefully you're saying they estimated a number in terms of getting you pre-approved. You don't have a property under contract, so you can't get it locked. And hopefully we get good election results and good Fed results and a slightly weak jobs report. And by the time you get a property under contract, you're looking at better terms.
I think what happens, Josh, is people see that today's interest rate somewhere around 7%, and then they say, hey, well, my APR is being quoted this. Well, that could be good and bad. It could be great, or it could be really bad depending on what type of loan you have and where interest rates are actually on where they are on those loans. So my guess is if you're buying a home and that's your quote unquote APR, you probably have some sort of government loan with an interest rate probably a percent or not more lower than that, or it should be lower than that. So if it's not, you should be probably using that referral link at the bottom here and having a conversation just to confirm that the deal is what you think it is. Josh, here's a comment. Someone that is using maybe the rate watch. We can find out.
No, Paul absolutely signed up through the Rate Watch. We have his mortgage statement. We've got him set up, and we have the number tracked. So as soon as that opportunity pops up, it's a good sized loan at a relatively high interest rate. So it's not going to take a whole heck of a lot for him to be in a position for it to make sense.
All right, Josh, what do you think about someone making a comment, or I guess a mortgage? I won't use a professional, a mortgage person making the comment that they don't think rates will ever go under 5% again unless we have another recession.
Well, Jeb, what are the odds of us never getting another recession?
That was my point exactly.
Yeah.
0%.
So, I mean, that's dumb. Unless this thing that is certain to happen at some point in the future happens, we won't get this other thing to happen. So the recession is certain to happen at some point, whether it's next year, whether it's 5 years from now, 15 years from now, you're getting another recession. Will that lead rates under 5%? Who knows? We've gone through this in other episodes. We've gone through this in the live show. Do I think we're getting rates under 5%? I do. I don't know when that will be. There are reasons for it. But it will require, if not a recession, a very slow growth economy. And the big fear right now, the thing that is keeping rates elevated, inflation is not back to levels where the government would like to see it, where the Fed would like to see it, but it's getting close and it's approaching that level. But what is not there is government spending. And the crazy thing is, we talk about this election. We talk about who's going to win the House, who's going to win the Senate, which one of those two characters is going to be the next president. You know what none of them have talked about? No one running for Senate, no one running for Congress, no one running for president has said, hey, we spend billions of dollars more than we have. Here's how we're going to get it under control. What they say is, hey, I've got some new ways to spend. I've got new ideas to spend.
Elon said he could save $2 trillion.
I saw it. But the interesting thing is, Jeb, I look at it and I want to hear it. Elon's smarter than I am. So you are not going to hear me say, hey, that crazy, weird genius doesn't have a way to figure this out. He quite possibly does.
Did he say what his plan was? I just saw the headline.
He didn't. Yeah. I saw it. I saw the video, and it was semi tongue in cheek. It was the WWE rally head at the Trump rally was really, he was looking to get him something to say something that would stir up the crowd. He didn't go into details on it, but I've seen the numbers, discretionary and non-discretionary spending for the government. There's not $2 trillion of non-discretionary spending. So there would be some really, really tough choices that have to be made there. So again, you vote your heart and your conscience. When I look at it, really, if he were placed in a role in the next administration where he's in charge of government efficiency, that's what they're talking about. They're creating a Department of Government Efficiency. I would love to see a government efficiency department, because we have a really inefficient government right now that spends way more money than it has. So you may disagree with the person that we put there, but we talked about this, and I think I showed the chart on a show a month or two ago, Jeb. Republicans don't like any proposal that Kamala has. Democrats don't like any proposal that Trump has. When they poll the Republicans on Kamala's spending plans, they're all in favor of it. When they poll Democrats on Trump's spending plans, they're all in favor of them. That's mind-boggling. You cannot agree with the person on anything other than their plans for spending money when we spend too much money.
That's as far as we're going tonight with politics. Kevin has a good question here. Josh says that you guys have already talked about it, but let's talk about escrow accounts. What escrow accounts are. Impound accounts might be another way that you've heard it said. Pros and cons of both. So I'll start. Josh, I have an impound account, which means my taxes and my insurance are included every single month when I make my mortgage payment. Why do I have that done? Simply ease. I don't like my property taxes, like a lot of people's in California, aren't cheap based off where I bought my house. And so I don't like seeing a bill come in for, X amount per year being paid in large amounts.
Twice a year, big chunks.
I'd rather just pay it, annually or pay it monthly rather, because the amount of interest that I would earn on that money is pretty minimal to begin with. I'm not going to invest it that much money in something that's the return is going to be infinitely that much better than just sending it into them and letting them do their thing. So that's the pro of it. I guess, Josh, what's the con?
I would say the biggest con is the folks that manage your impound account. They're doing it with software. It is low level overseas employees with software that are managing your impound account. So you're going to deal with your mortgage payment changing every year, which can be legit. I mean, your taxes, your insurance can go up, but they are allowed to keep a cushion in that account. And so if they refund too much money back, which I have happen with clients all the time, we have a nationwide servicer that many of the borrowers' loans get placed with, that they will reassess or they will reconcile that impound account for a California borrower 3 months after they closed. Well, you're not going to be reassessed. So if you bought grandma's house that paid $42,000 for it and the assessment's $100,000, but you paid $700,000, I've had them send $5, $6, $8,000 back to my borrowers. And guess what? At the end of 12 months, they go, whew, your impound account is way light. We need to add $600 a month to your payment next year to get back to where we should have been. So that's the biggest thing. I'm with you. I have an impound account on every mortgage that I have. It is a pain in the butt staying on top of it. I don't, just like you said, Jeb, I don't think I'm going to invest that money somewhere that I'm going to get some spectacular return where I'm missing out on anything. Just the simplicity of one payment going to the lender. We talked about me looking at my insurance statement. That's kind of a downside. When you're not paying anything directly, you don't pay as close of attention to it. I generally do look at my property tax bill. I don't look at that homeowner's insurance all that often because I've been in my home for 22 years this year. And until the last 2 years, it goes up $40 a year. Who cares? It's $3 a month. When it goes up $400 a year, you're like, ooh, you got my attention on that. So those would be the big ones. But I agree with you. And I would advise most of my clients to do it. The extra headache, hassle, worry of taking it on yourself, but definitely pay close attention to it. And if you ever get a big check from your servicer that says they have too much money, they're probably wrong. Check with your lender and let
I
them
actually did
walk you
get
through
one
it.
of those, and it was a decent amount. In fact, my payment on my mortgage dropped like $400 from the initial payment, like 4
Why?
months later, and
Why?
that they overcalculated the property taxes initially through
Who did?
the original lender
Okay.
somehow.
Okay.
Yeah,
So here, this is a good discussion. We're using Jeb as a really
yep.
good example. So high purchase price. Are you comfortable saying what you paid for your home?
1.5.
So 1.5 million in a state where for us in Huntington Beach, about 1.15 on the taxes. So when you're looking at that, $18,000 a year. So $400 off a month, they were off by about $5,000. Most likely what happened is the lender used 1.25 because that's what underwriters like to use in the state of California. And they didn't get a tax cert that went through that said it's actually 1.14 for this property. And therefore that really high purchase price was off enough that you were due to receive a refund. Because I can tell you, it is incredibly rare
No,
that
it's first
they
time.
send back that big of a check and it's accurate.
Yeah.
99 times out of 100, I tell the people, do not spend that. Go put that in the bank. You're going to be giving it back to them at some point
Well,
in the near
that's what I
future.
thought. So the money's just been sitting there thinking that at some point they're going to ask for all of this back, and yet it's not happened. So, well, I've actually refinanced since then, and it's all been good. So I think we're good, but we'll see. But something to pay attention to. So to each his own. But some loans require it. Just FYI. Sometime when you put less than a certain amount down, it might be required. So sometimes you might not have the option of choosing whether or not you have that impound account. It might just be required. Just heads up. Josh, we got somebody here that has not locked their loan. They're closing in less than a month. And they're asking, should they delay their closing until December to see if the rates will go down a little bit? What are your thoughts?
It's risky. So anytime someone tells me, I think there's a chance here and I might be willing to take the chance, I ask them a couple things. If rates go up, does it blow your loan approval? Are you at a maximum debt to income ratio where we can't absorb a higher interest rate? So you would either walk away from the deal or now have to pay points to buy the interest rate down. That tells me we probably shouldn't be gambling at that point. I like to ask, what is your risk tolerance? When you go to Vegas, do you head to the buffet or do you head to the slot machine as soon as you get off the airplane? That tells me your attitude and your approach to it. So if you have some tolerance for risk, the market right now is volatile. At the top of the show, we went through a bunch of things that happened in the next business days that will impact the direction of interest rates. I am hopeful that they're going to go lower. I don't know that I would be, I will say this, I don't have a client right now that is in process, either with a refinance or a purchase, that does not have a locked interest rate. Doesn't guarantee that that's going to be the best decision, because we've seen a big run up. You would expect something to turn around at some point, but Jeb's favorite saying is markets can remain irrational longer than you can remain solvent. So just thinking that we're due for a bounce doesn't mean we're going to get that bounce. Maybe it doesn't come until January. So maybe you can tell my gut feeling on it is always the borrower's decision. We are always going to have that conversation. I'm going to ask them some questions that hopefully they arrive at the decision that fits best with them and their risk tolerance.
Yeah, and me personally, I've become very contrarian to this whole thing recently, just because everything is done opposite of what I thought it should do for, I don't know, an extended period of time. And rates did get down into, high fives like we thought that they would. I didn't think we would see another run up. We have, and not only have we seen a run up, we've continued to see things run up. And there's not really a lot there to honestly support the run up that we've seen. And so it's just kind of snapped back. And part of that was anticipated. We talked about, the idea of price cuts being built into the market already, rate cuts being built in to what the Fed was doing. We talked about that and how it's likely you're not going to see this pullback in rates as soon as it happens. And that's exactly what happened, right? We saw the opposite, in fact, which again wasn't really a big deal. And then all of the things around the political climate and inflation and what they think, these different policies are going to do. It's just is it headline grabbing? Is it real? It's hard to say. And so I'm kind of on the other side at the moment saying, hey, look, I think you should just lock. If you're less than a month out, are rates going to drop 0.5%? I mean, it's possible. Is it likely? I don't know. I don't think so, just because of where the market is. I think the next couple of days are telling. If you don't get the numbers in PCE and jobs on Friday, I don't think you're going to see that big move. Now, if both of those come in good, then there's a chance you could see a bigger move once the election happens. But I think if both of those are bad, I think the election could be the catalyst for even higher rates.
Well, Jeb, we talk about data dependent. And so, okay, cool. What does that mean? And what is the data? Well, you talked about it. PCE tomorrow, October jobs on Friday. But the problem is, at least with the October jobs report, and we had the hurricanes in the last month. So let's say it comes in super low. Does the market go, well, it's super low, but that's because there were hurricanes and people couldn't work for 3 weeks. So we have lower job creation. Things can get dismissed in the short run. There's just a lot clouding the insights into the market right now. So the markets are kind of reacting defensively. I think they're overreacting defensively, but we'll see as that data plays out.
Good stuff. Josh, when comparing your interest rates, we talked about this again today in the episode that we recorded, but when we're talking about rates of, say, a broker like yourself versus a bigger bank, not to use names, but think of the bank that anybody banks with. It could be one of many. Are your rates better than those banks typically, or do those bigger banks have something that you don't?
If you are not a private client with one of those banks, and absolutely if you are not getting a jumbo loan, we are going to be better than them 8 days a week. I have a client that actually going to be signing docs on Friday, FHA purchase. They went to one of the banks here mentioned, and it was 0.25% higher in interest rate, and they were charging them a point.
Mm-hmm.
It's a pretty big difference. It's at least a 0.5% difference in interest rates. I wouldn't normally say that is the scale of the difference that you would expect, but we talked about if you're going to get a government loan, you probably should be going to a broker. I said at the top of the show, there's not one channel that's the best, but if you're getting an FHA, VA, USDA, you're probably going to get the best terms from a broker. The biggest issue, or that I hear when I see this question, is again, my buying decision is the lowest interest rate. Is your interest rate the lowest? I'm the best. I have very good interest rates, but I am the best. Now, am I saying that of the 300,000 or whatever originators there are in the country that I am literally number one? Probably not. But if you make 100 calls, you're going to get 80 or 90 people that you wouldn't wish upon your worst enemy. And when you make calls and ask, what's your interest rate? Again, go back and listen to that show that
it's not recorded yet. It's not out yet, bro.
It's not out yet. Listen to the thing that's not available. because you're asking the wrong question.
Ooh,
And you are walking face first into a buzzsaw because you are telling that hack salesperson what your buying decision is and what they have to tell you to get you. If you make 10 calls, I'm going to be cheaper than 8 or 9 of them. The 1 or 2 that are cheaper than me are not appreciably cheaper where you would go, hey, I don't want the expert. I want the guy that's the cheapest.
Maybe that's an offer, Josh, that we release the podcast to a members only thing like a week or 2 before. Like, hey, go listen to this. It's not even out yet.
A private library of our conversations that you and I have every morning.
You could be a private client. Josh, this is something I conspiracy things are, drive me bananas. And not to say this is one of them, but the idea that I've heard of cases where mortgage services change and they misplace impound accounts. I would never have one. I've owned, I don't know how many mortgages in my life, a bunch, and they've never lost my impound account. In fact, I don't know of anyone that's ever lost their impound account. Has it happened? Possibly.
I say no. I say no, it hasn't.
But when I in all reality, even if it happens, it doesn't matter. Your impound account is there, so it's not your problem.
Yeah, they have to pay it for you. My account, you're the servicer. You service for the owner of my mortgage, and as part of that agreement, when they purchased my mortgage, they have to pay my taxes and insurance. When I read this, I said, I've heard of banks becoming insolvent and going out of business, so therefore I don't use banks. That's the equivalent to saying that. Of course you use banks because they're safe and they're insured and there is the rule of law behind you. If you're worried about a servicer not paying your taxes and insurance and making you pay it, you're worried about like society breaking down and the rule of law no longer existing.
That's a stretch there, Josh.
That's a stretch. So I'm saying that's a little out there. I wouldn't go that route. I wouldn't forego the massive convenience of the impound accounts that I have, which I've had with many lenders, many banks, many servicers. And the biggest problem I've had is, again, with them coming back, oh, we screwed up last year. You owe us an extra $195 a month for the next 12 months.
So, Josh, I see this comment as saying that they have a rate of a certain amount. And they're asking where should rates be in order to refinance. What I'm thinking should happen, Josh, is there should be another tool created that uses the rule of 125 that you often use that shows people what they need to save in order for it to make sense. So possibly that's something that we need to write down and create to give people a place to go. Be fairly easy to create it. But Josh, how does someone determine where their rate needs to be in order for it to potentially make sense? Obviously, it all comes down to cost and fees and that sort of thing. But is there a general rule that you like to use?
So when we're thinking in terms of a 0-point loan where you're not paying to buy that interest rate down, take $125,000, divide it by your loan amount, and then that's going to tell you the percentage savings on a 0-point loan that you need to get. So if you have a $500,000 loan, 125 divided by 500 tells us 0.25%. If you have a $125,000 loan, 125 divided by 125, I need to save at least a full percent. Now, the confounding factor, that number works better in low closing cost states like California. Many of the Western states have lower closing costs. If you're in, say, a Florida, where there's an intangible tax on your refinance, it's going to bump that up. And Florida has more affordable housing than California. So I talked to a lot of people with $275,000, $285,000 loans in Florida that would say, hey, a 0.5% savings is enough to make it make sense. And when we go through the costs, including the taxes, they go, ooh, I'd like it to be a little bit more than that. But it is it is a rule of thumb, and it's a good rule of thumb that says, hey, I am in the range where I should start a conversation with a mortgage professional. It doesn't say, hey, I need to go refinance tomorrow, but I should start that conversation.
All right. We have a question regarding credit cards. Is there a number that you should have, a limit of number? No, you can have as many credit cards as you want. There's no limit on the number. In fact, I have a bunch. Most of them are zero balance, unused. I only use 2 different cards, but I have I don't know, 7 or 8 probably that are available there to use. Ones that I've gotten over the years, they're free. They're just out there. I keep them for a number of reasons. One, just available credit, right? That you're not using does help your credit score. What you don't want to do is apply for a bunch of credit cards at the same time and have a bunch of inquiries and try to open a bunch of credit when you preferably right before you get a mortgage. You don't want to do it. But
Jeb, how about the flip side of that? Most everyone knows, hey, I'm thinking about getting a mortgage. Don't go out and open a bunch of new cards. But some people say, oh shit, I've got 10 credit cards. I'm going to get a loan. I got to fix this. I'm going to go close 5 of them. Don't do that either.
Yeah, to talk to somebody first before you do anything. There's a couple of ways for professionals like Josh and you know, to use these simulators, if you will, to kind of see what things would do by changing some things on credit. So there are, you know, ways to figure out how some of these things might impact you, changing balances, you know, upping your credit limit, just different things, and how it might impact your score. So before you make any we'll call them irrational decisions when it comes to credit, talk to somebody that deals with credit day in and day out before you do that. And then I'm going to piggyback off this, Josh, and say, if you have bad credit scores or credit scores lower than where you think they should be or where you want them to be, and you're thinking of quote unquote credit repair, be very careful. There's a lot of scum people out there that claim to do credit that overcharge and we'll say under deliver on things and get things off your credit that pop back on. The reality is you can do everything they're doing if you know how. Now that could be said about a lot of things, and time is important, and paying other people to do things. There's definitely something there. So there are reputable people in the industry. So reach out if you want somebody that's reputable. Don't go paying people monthly service fees when they don't have a track record of success. And there's big companies out there that prey on this sort of thing, Josh. And I heard you have a brief conversation today about one of those companies
with the listener.
Yeah, and the reality is, yeah, you should avoid that stuff. It's an easy trap to fall into.
And I will say
they prey on the people that need it the most.
If they're huge, that's problematic. If they're a big national company that you're coming across in Google searches, it's a problem. The company that we refer and recommend, the owner of the company will tell you, nothing that we do can you not do for yourself. The initial consultation with them is free. And in that, they're going to give you the roadmap. Here is how we are going to attack your issue and your plan. And it depends. The gentleman I was talking to this morning has a 603 credit score. We can probably get him an FHA loan with a 603. He's going to pay a premium for that. So if he can spend a couple $1,000s, not to them, but in terms of paying off some things, clearing up some collections, working through that stuff, and get it up to a 640, it's going to save him multiples of that thousands of dollars. So they're going to tell you, they say, here's our plan. We're going to dispute all this stuff. That rarely works, but it's step number one. While we're disputing it, we're going to say, hey, we know that of these credit companies or collection agencies, we know who plays ball on pay for deletions. So you have 5 collections, these 3 play ball, and they're only $1,400. So let's see if we can do a pay for deletion, and poof, those are gone. And we now have 20, 30 points improved on your credit score. Maybe one of the disputes makes another one go away. Maybe now it's adding a credit card that will get you a better credit mix. Maybe it's adding you as an authorized user. There's all sorts of tips and tricks. So there's a cost to it, but a reputable company. I've had clients go, I mean, the most common example is not someone who's an FHA buyer and we work on it to get them up where they're a conventional buyer. It's the 580, 590, 604 credit score borrower, and we get them up to 640 or get them up to 680 within a 3-4 month period is pretty reasonable. And it makes a huge difference on your process in terms of the terms that you're getting, and having an automated approval and a smoother process than trying to do a manual underwrite on a lower credit score.
Good stuff. So if you found any value tonight, do us a favor, hit that thumbs up. If we can help you, there's a link in the description of the video. Until next Wednesday, adios.
Amigos.